Good morning, everybody. And give everybody a couple more minutes here to get in. I see I've got some more people coming in, and usually takes a couple seconds for them to get on the platform. So bear with us for just a couple seconds, and then we'll get rolling. All right, so let's see. I see we've got Ellie's on, Francis, Michael, Kathy, Frank. Nice to see you guys here today. I'm gonna get going here. Respect your time. So it's about 3 minutes after the hour here. So other people will just say join. Will just kind of pick us up where they are. And a reminder: after the webinar is over, a couple hours later, you'll receive a email with the link to the recording. So if you missed something or want to go back, take a look at it. If you don't get that, give us a shout. We're happy to share it with you. So let's get going here. So that's a little about me. We've been doing these webinars now for, I guess this is maybe the 6th one. So it's been interesting. We've had a lot of fun with it. We're getting some good feedback from it. So we're happy to continue, and we'll talk a little later in the presentation here about asking you guys what you're looking for from us, and so we can be on target for what you're looking to hear. Today's agenda, we're going to talk about the CARES Act, the changes that were made with that, strategies to use the CARES Act plus the potential opportunities that we have with the pandemic, what that's doing to your business. And we are seeing some companies are actually making more money, some are making less, and then we've got some landmines to look out for, things we've learned in past recessions and where we've had disruption in the marketplace, and some things to really pay attention to. It's fortunately kind of mid-year or almost mid-year, and it's a good time to start thinking about what can be done to maximize your position, save in taxes and maybe do the right things financially. So we'll talk about steps to take now and how to prepare in ways that we can help you make the best business and tax decisions. I got to point out, real quick, it's our standard process to prepare tax projections in July and in November, kind of mid-year and right before end of year for our clients that are on our monthly packages. This year provides some opportunities that we wanted to share with everybody and make you aware that it might be, more than an unusual year, and you really should be paying a lot more attention to this stuff. So, CARE Act provisions. So, to take a quick step back and not get too deep into the law here, but in 2017, the what we call the TCJA, which was the act that was in the tax law that was enacted, by Trump early on, made a bunch of changes, and the CARES Act rolls back some of the negative effects of that law and allows us to do some things that perhaps maybe we once could, like the net operating loss. That's what NOL is. So if your business has a loss, used to be you could carry it back 2 years, some years you could carry it back 3 years, but the TCJA law of 2017 restricted that and didn't allow you to carry losses back any longer. So the CARES Act has reinstated temporarily the ability to carry a loss back, and they're saying for losses generated in 18, 19, or 20, you can carry those things back 5 years. And what that means is if you lost money, and if you lose money in 2020 in your business, you may be able to carry that loss back to 5 years ago, where maybe you had profit and actually get a refund. So what we're going to need to do is watch how, whether businesses are making more money or making less money. And then if they're losing money, we have to kind of weigh the benefits of some of the other things that we'll talk about today versus maybe carrying that loss back and getting some refunds of previously paid tax. And as you can see here from our slide, there's different rules for different years. The TCJA also put in an 80% income limit, which meant you couldn't completely wipe out your income with a loss. You can only use 80%. So you would end up still having taxable income of 20%, even though you had this loss that you were carrying forward. So it removes that in these carryback situations. It's expanded what they call 163J business interest deduction. I'm just going to point it out. It really only is for companies with revenue over $25 million. And we've got some construction type contractors and some businesses like that who might get into that. And if they've got interest expense that they're deducting, there's limits on it. And the CARES Act has kind of been able to, take that limitation off and allow us to maybe deduct that interest. So again, it doesn't really apply to most of the folks here on the call, but I'm going to point it out here just in case someone hears it in the replay and it could be important to them. The TCJA also had it's pretty widely seen as an error. And the CARES Act fixes that error by expanding this qualified improvement property deduction. So go back to prior to 2017 in this TCJA law, there was a qualified improvement. So think building improvements, not structural improvements, but build out of interiors and stuff like that. Those things went from being a 15-year depreciable asset to a 39-year depreciable asset. And the problem with that is that 15-year depreciable assets, you can use bonus depreciation and expense it all in the year that you did the improvements. Whereas 39-year, other than it being more than twice the amount of time you could depreciate it, it also didn't allow for bonus depreciation. So the CARES Act has fixed that problem in what was in the TCJA. So what that means for you is that if you're doing some expansions, you're doing building renovations or leasehold improvements, you might actually be able to deduct all of that in 2020. So if you spent $50,000 on building improvements, instead of having to take that as depreciation over 39 years, you can expense it all in 2020. Another issue that they've allowed here is you're allowed a $2,000 distribution from a 401k or an IRA type account penalty-free in 2020. Still have to pay the tax. It's still income, but if you're not 59 and a half, you avoid the 10% penalty. So if you decided you wanted to take $100,000 out of your retirement account, you still got to pay the income tax, but you wouldn't pay the $10,000 penalty for taking the money out too soon. Also in 2020, they're not requiring the RMD, which is the required minimum distribution. The other change that has happened, it wasn't in the CARES Act, but it was another law from this year, was that the age of requiring distributions was moved from 70 and a half to 72. So we have seen a few clients who had already triggered their required distributions and taken money out of their IRAs, were going to have to pay taxes on it in 2020. We're able to, quickly undo that, put the money back into the retirement account, and not actually have to pay the tax on it this year. I'm also going to point out this is not an all-inclusive list of all the things that are in the CARES Act. It's over 800 pages of new law. So I'm pointing out the things I think that are most important to our individual and small business clients. Also, there's another thing that's in here that I didn't cover, but it's you can take there's new rules on how much you can borrow from your 401k. It used to be $50,000. Now it's $100,000. So, instead of actually taking a withdrawal and still having to pay the tax, you might be able to borrow 100 out, which means you have to repay it to your 401k plan. The challenge there is, your 401k plan has to have enacted these changes, and so you're going to need to, if that's something you're looking to do, have a conversation with the 401k custodian to see if they've made those changes. So I think before we get into the next section here, I'm going to try to run a quick poll. Hopefully you all are seeing that. So what do you project profits to look like in 2020? Less than last year, more than last year, or about the same? I'm curious to see what everybody's thinking, and I, also, of course, any PPP loans you may have as of now look like that's going to be additional income, and that might change your. I don't think I've published this here. Let's try this again. So if you're seeing the poll, go ahead and answer that. Okay, people are answering, so that's good. I think personally, and again, it's early in the year, so you're judging, what the rest of the year is going to look like based on what's happened in the first 5 months here. I would say we'll be pretty close to maybe a little positive over the prior year on our end, and that's of course assuming that the PPP loan is all going to be income. So with that, it might actually be more income. So okay, so I'm going to go ahead and end the poll. And I think that is publishing, but it looks like we didn't have a lot of people answer it, but it's a 50-50 on less than or about the same. So I think it depends on what you're doing and what the economy is going to show, going forward. And I think that's the big question mark. What's the consumer going to do? How are they going to be feeling, and whether they're going to be willing to spend money, and if they're, they have jobs, and I think if people go back to work and they feel that things have stabilized, I think that might there might be some pent up demand that could surprise us, but that is dependent on everybody going back to work. So strategies if profit is down. So as I mentioned, the carryback loss changes make it, an opportunity to say, hey, we lost money. And it's not just you have a reduction, but you've actually lost money in 2020, and I want to carry those losses back and get a refund in a prior year. And this becomes more of a projecting what it is, deciding, whether the tax rates, are better in those prior years or higher in those prior years, or your income was higher in those prior years, and it makes more economic sense to take a loss carry back and get money back versus carrying those losses forward and taking the tax benefit later. So we can help you with trying to decide when it looks like there's a loss, where is the best place, where do you get more bang for your buck. Accelerate income to take advantage of losses and low tax brackets. So if your income is down this year, we can look for ways to create new income, or to take advantage of maybe lower tax brackets this year versus next year. And accelerate income could be something like a Roth IRA conversion, or withdrawing money from your retirement account. So you're pulling it out now, you're adding it into income in 2020, and you're paying the tax, but you're paying it at a lower rate because the regular amount of income that you were expecting isn't there. Also going to point out some estate tax, death tax strategies, and as far as gifting, when values are low, sometimes it makes sense to do some gifting, and maybe it's assets to a family limited partnership, or gifts of stock of your company to the next generation. What can be done to take advantage of a bad year. So Sell gain assets. So, if you've got real estate or you've got, long held assets that have a very low cost, and it would make sense to lock in your gain now while your income is low is really what we're looking at here. So just kind of thoughts for ways to use make something good out of a bad situation. What can we're having a down year, what can we do to take advantage of that down year? And these are some ideas. So what are the strategies if profit is up? So, I say buy new assets, to take advantage of the bonus depreciation rules. So you can buy it this year and deduct it this year. Maybe you've got a need for vehicles. I would think that, certain types of vehicles right now, the car dealerships have all been shut down. There might be some opportunity to get yourself a deal if you need new vehicles, business vehicles. Improve your property, and that goes back to the QIP, qualified improvement property 15-year, which now can be bonus depreciated, and which means you can, deduct all of that this year. And, there's some limitations and some restrictions on that. So just, don't run off and do that without having a conversation with us first to make sure that what you're going to do is going to qualify. Take advantage of your strength. So if you're having an up year and everybody else is having a down year, should you be expanding? Can you take advantage or take over a weak competitor? Just some things to think about. Not everybody's business is super strong right now, and there are some people who are, maybe looking to get out. Maybe they've got, maybe you can acquire a competitor, maybe not take on their real estate, not take on their rent, and absorb it within your business, and not greatly improve your cost structure, and not only take out a competitor, but also take on their extra business. So defer and shift income. So defer and shift income is more of our standard tax strategy. We use these in regular years, up years, and we talk about changing entity structures or reorganizing your business to take better advantage of the tax aspects of different types of businesses. Qualified plans, so putting money aside into 401k plans and IRAs and Roth IRAs, maybe taking a deduction for that now to pay the tax on it later. And then, we've got a whole bunch of other more complicated tax strategies that are really beyond the scope of this particular presentation, but it's, suffice it to say, there some are qualified plans like, defined benefit plans. We've other ideas that are out there, from charitable trusts to, other things that are available if someone's got a large increase in their income, or they've got a one-time event that's creating a tax spike, in ways that we can try to plan for that. But again, it's planning. So you need to, if that's coming, it's best to have a conversation with us before the event so we can plan it properly. I thought I'd just take a minute and talk about the economic landmines. And some of this planning in some of this presentation are based on, having run through the Great Recession, back in 08 and 09, and the things that we learned in watching that unfold. And, one thing that's got me concerned, and I've been talking to a lot of bankers, and nobody is telling me yes, but nobody's telling me no, was, we saw, the banks being pressured by the regulators and by the government to clean up their balance sheets and reduce their leverage. And the way they did that is they went to their business and their individual clients, and they said, hey, you've got a $100,000 line of credit with a $20,000 balance. You now have a $20,000 line of credit with a $20,000 balance, followed by the letter that says, oh, hey, you're at 100% of your available credit. You're a bad credit risk. We're raising your interest rate and we're increasing your minimum payment. And it wasn't anything the business owner or the individual did, because we saw it on business lines of credit, and we also saw them on home equity lines of credit, where this in credit cards, where this happened to a lot of our clients back in 08 and 09. This created cash flow problems in businesses that didn't maybe have cash flow problems before. So, they had a line of credit, they were making a $200 a month interest payment. Bank closes the line of credit and forces them to pay it off over the next 24 months, and now they're paying $2,000 a month on their line of credit to pay it off, and they don't have the ability to borrow against it anymore. So, I think we're gonna have to wait and see what the banks do, but also what the regulators and the government, tell the banks they have to do. But right now, I would be hesitant to pay down lines of credit if you thought you might need them later. I'd rather see you pay a little bit of interest on those those balances than to, take your available cash flow to pay those down and then have your available the ability to draw on those when you need it to go away. So just be careful of that. Missing out on opportunities by not planning. We saw cases where we didn't know what the clients were doing. We didn't know that their businesses were struggling as much as they were, and they lost money, and then they came to see us, the next year to get the taxes done, and, there wasn't a whole lot we could do. We could carry some of those losses back, but, sometimes you miss out on other deductions, or some things don't carry forward, and you kind of miss out. So you want to pay attention during this time and make sure that you can take advantage of these opportunities. Not considering your itemized deductions. So we saw a lot of that back in 08 and 09, where, there were losses and they could carry the losses back, but, your itemized deductions, your home mortgage interest, your property taxes, your charitable contributions, all those things, you don't get to carry those back. If you don't have income to use them, they're lost, and they're lost forever. So charitable contributions will carry forward, but the mortgage interest and the property taxes will not. So, there were cases I remember from 08 and 09 where I wish I'd have known. We could have done some stuff. We could have taken money out of IRAs, and we actually did that in a couple of cases where we knew people were getting rid of real estate. They were going to lose a bunch of money on their real estate transaction. It was going to wipe out their income for the year, and then they had itemized deductions, and their income was, a couple $100,000 negative because of this transaction. And we, before end of year, which is when all this stuff has to happen, we're able to convert one individual. It was $200,000 or $250,000 of his IRA into a Roth IRA, and the loss that he had ate up the income. He never paid any tax, and because now that money is sitting in a Roth, he will never pay tax again on that money. And I felt good that we were able to make that move and secure that and avoid the taxes. And those are the kinds of things that I'm really wanting to see us be aware of, with your situations, and make sure we take advantage of those. So PPP income, as far as I know right now, if you've got a PPP loan, it'll ultimately be income. Whatever is forgiven will, basically they're saying you can't deduct the expenses that you pay with a forgivable PPP loan, which is the same as income. So, we have to work that into it. Just as a, aside, they're changing all the rules on this, so we don't know the answer yet. But it's something that is potential to cause some problems, because we've got people with $300,000 PPP loans. Well, that's a $300,000 of extra income that maybe they weren't expecting. Cash flow needs. I know, along with my first topic here of watching out for your bank line of credit, shore up your cash position. We don't know how this is going to, unravel here as the economy opens more and more, and we get into, the summer here and early fall. Will things continue to improve, and your cash flow is fine, or could we get shut down again? Could there be a flare up in the virus, and it causes further problems? So now's the time to plan and be careful with your cash flow. And then, of course, there is the future, and we are due to have an election here in the United States in November. and I couldn't tell you which way that's going to go. And I think, obviously, come first after the election, so into the second week of November, we at least now will have a little bit more clarity as far as who won the election. What does their platform say about increasing or decreasing taxes, and what we need to plan for, and of course inflation. The government is spending a bunch of money on the PPP loans and all the stimulus, and they're running up another couple $1 trillion in debt, not to mention the fact that if businesses aren't making any money, the tax revenues are going to drop. So, what is inflation going to look like? Will it mean that we're going to have to raise taxes, and or the cost of things is more expensive because of inflation? Just another example of planning. Prior to this whole virus issue, we had a conversation with a client who's thinking about doing some gifting to reduce their potential estate tax. And, I said, well, there's no real reason to do it now, but let's have a conversation in mid-November, because after the election, I'll have a little bit more clarity as far as whether I think there's the opportunity for taxes to go up or not. And, so we've already got that scheduled to have that conversation in November, because it could very likely be something that changes. So I'm going to stop here real quick and run another quick poll. And this is what can we do to help? We've been running these webinars now, and I've got my own opinion on what I think our small business clients need to hear from us. I also think I can watch the attendance alter by topic, and I'm just kind of curious as to what you guys are interested in seeing most from us from an ongoing standpoint. So we offer, I can talk tax reduction planning strategies all day and put you all to sleep, but a lot of times that's tax dollars in your pocket, and people like that. We can talk about the PPP loans and updates that are coming on that. Those are topics that seem to be very well, or those things are very well attended. More on improving your business and creating value. We've done a couple of those. We offer one-on-one business coaching. We offer, we have the potential for offering some online small group coaching and masterminds. And if anybody's still out there, you can go ahead and click on those polls. Let's see. Maybe I don't have it working right. Okay, I'm going to move on. Okay, so what do we do now? So, it's early June. We're 5 months into the year. We've, had a shock from the virus and the shutdown, and we don't know where the economy is going to go. But we know that the important date is that any moves you want to make must be made before 12/31. So keep an eye on the year. Make sure you're watching your results in your business. We do mid-year reviews, as I mentioned, for our monthly clients. We do a year-end review, also to run projections to see if there's where the business is, and then have those conversations with our clients. Don't like to be surprised by the tax bill, and when we do those meetings in July and November, then we have projected out and told them what we think is going to happen and what their tax results are going to be, and what they can expect and need to write a check for by April 15th. So and we're usually pretty accurate with that, even though we're doing projections, because by November, of course, the year isn't complete, but there's time to make a change if you need to. And of course, real-time accounting is the key to it for us. So when we say real-time accounting, we're generally talking about using QuickBooks Online to work with you, the business owners, to keep your books up to date on a daily basis and make sure that you're not coming to see us in November with the pile of receipts that you haven't paid any attention to your accounting, and now we're supposed to try to figure out where you are. And it's best if you keep it up to date so you can see the results in real time, day to day, week to week, month to month, and be able to plan properly. So how can we help? We offer, and just by the folks that are on the call, some of you know this and are already kind of part of this, but we offer fixed fee monthly packages that include real-time accounting, tax preparation, and at least the 2 times a year scheduled planning, the July and the November. We also offer tax plans, which are usually more of a reorganization type of scenario, where we determine that there's things that you're doing that we need to restructure to put you in the best tax position. And we also will do scheduled tax projections, and we do a lot of those when people sell something. Hey, I'm selling this piece of property I've owned. What's my taxes? What are my taxes going to be? So, in those cases, it's usually a transactional event. But for businesses, it's a little harder, because if your accounting isn't up to date, it's really hard for us to tell you where you're going to be for the year. So, please, give us a call or drop us an email if you're interested in more information or pricing related to our services. These are the things that will allow you to watch your business and know where you are and be able to properly plan to not miss a huge opportunity. Like we said in the title of the presentation, there's a huge opportunity to make moves that can save you. Maybe it's not saving money this year. Maybe it's a matter of using the loss right now to create an opportunity to save, convert your IRA to a Roth IRA, and you save money for the rest of your life. Now you've got tax-free income in retirement, and maybe that's the way to go. Or maybe your income is dropped significantly because we do have individuals who have lost jobs, and those jobs, sometimes there's an opportunity because they're used to having a bunch of income, and now their income is less, and there's some opportunity to do that. So please keep those things in mind. I'm now going to see if we've got, if you got any questions, please go ahead and drop them in the chat or Q&A field. And, of course, we're always here if you've got a particular question that's a little more personal to your particular situation, and we can certainly help find you an answer for that. So, I'm going to throw out, I don't have any questions, but I'll just throw out one that's come to my mind, and that's the, gee, Tom, when is it a good time should I roll over my IRA to my Roth IRA? And, that requires you to have a feeling for what you think the future is going to look like, as to whether taxes are going to go higher, taxes are going to go lower. I don't think there's necessarily a right or wrong answer to that, because we don't really know. I would think that tax rates are pretty low right now, and the chances of them being higher, given the spending that we've incurred in this pandemic, it's very probable that the rates go up. But if you've got an opportunity to do it and pay, something under 25% in income tax on it, that might be a good idea for later. Because later, when you're over 72, and they're making you take RMDs or required distributions out, that could very well cause your Social Security to be taxed. So, we do some planning with people who have, they've retired and they're going to start drawing Social Security in another 3 or 4 years, and we're pulling money out of IRAs now up to a point where they're comfortable with the tax bracket, so that when they turn, 72, which is the age now, they'll have less in those retirement accounts, and will have to pay, have to withdraw less and pay less tax than they would now. So anyway, that is a question we hear fairly regularly, and we do a quick analysis and say, here's what we think. It depends on your situation. What is your retirement income going to look like? What other assets do you have? We've had people who say, I'm moving to the mountains of North Carolina. Well, North Carolina has an income tax. Maybe you're better off taking some of that money out now. In Florida, where we don't have an income tax. So, but we can certainly help you do the calculations on any of those tax planning scenarios and find you the right answer. So at that, I am going to go ahead and wrap it up. Thank you for attending. Hope you have found our time valuable, and we can, if we can help you in the future, or if you've got any immediate needs for 2020 and how these, specifically affect you, please reach out, give us a call, drop us an email. We're happy to help figure out a way to save you taxes. All right. Thank you for attending. You all have a great rest of your day. Thank you.